Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Mutual funds, a diversified investment option for steady growth. Mutual funds. Mutual funds pool money from multiple investors to create a diversified portfolio of stocks, bonds, and other assets. This collective approach allows investors to assess a broad range of investments, offering diversification and reducing risk. Managed by professional fund managers, mutual funds cater to various investment goals and risk preferences, making them suitable for both conservative and aggressive investors. With liquidity and ease of buying or selling shares based on the fund's current value, mutual funds are an accessible option for long-term growth or income generation. However, investors should be mindful of fees and costs associated with these funds. How mutual funds operate. Pooling of funds. Investors purchase shares in a mutual fund, contributing to a collective pool of capital. Each investor owns a proportionate share of the fund's total assets. Professional management. Fund managers or management teams are responsible for making investment decisions on behalf of the fund's shareholders. They analyze market trends, economic data, and individual securities to construct and maintain the fund's portfolio. Diversification. By investing in a variety of securities across different sectors and asset classes, mutual funds help spread risk. Diversification can mitigate the impact of poor performance in any single investment on the overall portfolio. Net asset value (NAV). The NAV represents the per share value of the fund's assets, calculated by subtracting liabilities from total assets and dividing by the number of outstanding shares. NAV is typically calculated at the end of each trading day. Income distribution. Mutual funds generate income through dividends, interest, and capital gains from their investments. This income is distributed to shareholders, either as cash payments or reinvested to purchase additional shares, depending on the investor's preference. Liquidity. Investors can redeem their shares at the current NAV, providing liquidity. However, the timing of redemptions can affect the fund's performance, especially in actively managed funds. Types of mutual funds. Mutual funds offer a diverse range of investment options to cater to varying financial goals, risk tolerance, and investment horizons. Here's an expanded overview of the primary types of mutual funds. 1. Equity stock funds. Equity funds invest primarily in stocks, aiming for capital appreciation over the long term. They can be categorized based on market capitalization. Large cap funds invest in companies with large market capitalizations, typically offering stability with moderate growth potential. Mid cap funds focus on medium sized companies, balancing growth potential and risk. Small cap funds target smaller companies with higher growth prospects and increased volatility. Investment style. Growth funds invest in companies expected to grow at an above average rate, often reinvesting earnings to fuel expansion. Value funds seek undervalued companies trading below their intrinsic value, aiming for potential appreciation when the market corrects the undervaluation. Blend funds combine both growth and value investment strategies to diversify holdings. Fixed income bond funds. These funds invest in bonds or other debt securities, providing regular interest income with lower risk compared to equity funds. This includes government bond funds, invest in government securities, offering high safety and modest returns. Corporate bond funds focus on bonds issued by corporations with varying risk and return profiles based on the issuing company's credit quality. Municipal bond funds invest in bonds issued by municipalities, often providing tax exempt interest income. High yield junk bond funds target lower rated bonds with higher interest rates, accompanied by increased risk. Money market funds. Money market funds invest in short-term debt instruments such as treasury bills and certificates of deposits (CDs). They offer high liquidity and safety, making them suitable for short-term investment goals or emergency funds. Hybrid means balanced funds. Hybrid funds invest in mix of equities and fixed income securities, aiming to balance potential returns with risk mitigation. The allocation between asset classes can vary. Balanced funds maintain a relatively fixed ratio between stocks and bonds. Asset allocation funds adjust the asset mix based on market conditions or specific investment objectives. Target debt funds automatically adjust the asset allocation to become more conservative as a specified target date. It is retirement approaches. Index funds. Index funds aim to replicate the performance of a specific market index, such as the S&P 500, by holding a portfolio that mirrors the index's components. They offer broad market exposure with typically lower fees due to passive management. Sector and specialty funds. These funds concentrate investment in a specific sectors or industries such as technology, healthcare, or real estate. While they offer the potential for high returns if the sector performs well, they also carry increased risk due to lack of diversification. International and global funds. International funds invest exclusively in non-domestic markets, providing exposure to foreign economies and diversification benefits. Global funds invest in both domestic and international markets, offering a broader investment scope. Commodity funds. Commodity funds invest in physical commodities like gold, oil, or agricultural products, or in commodity linked instruments. They can serve as a hedge against inflation and diversify an investment portfolio. Fund of funds. These funds invest in a portfolio of other mutual funds, providing diversification across different fund managers and investment styles. However, they may come with higher expense ratios due to the layered fee structure. Key considerations when choosing a mutual fund type. Investment goals. Align your choice with your financial objectives, whether it's capital appreciation, income generation, or capital preservation. Risk toleration. Assess your comfort with potential fluctuations in investment value. Time horizon. Consider the length of time you plan to invest before needing access to the funds. Diversification. Diversify across different fund types to spread risk and enhance potential returns. Mutual funds fees. Understanding mutual fund fees is essential as they directly impact your investment returns. Here's an expanded overview of the various fees associated with mutual funds. Expense ratio. Definition. The expense ratio represents the annual operating expenses of a mutual fund, expressed as a percentage of its average net assets. These expenses cover management fees, administrative costs, and other operational expenses. Impact on returns. A higher expense ratio can significantly erode returns over time, making it a critical factor to consider when evaluating and selecting mutual funds. Sales charges, loads, front end load. A sales charge applied at the time of purchase, reducing the initial amount invested. For example, a 5% front end load on a $1,000 investment means $950 is invested in the fund. Back end load, contingent deferred sales charge CDSC, a fee charged upon selling the fund shares, typically decreasing over time and eventually disappearing after a certain period. Level load, ongoing sales charges applied annually, often associated with Class C shares, which can impact long-term returns. Redemption fees. Definition. Fees charged when investors sell their shares within a specified short-term period, designed to discourage frequent trading and protect long-term shareholders. Account fees, maintenance fees. Some funds charge manual account maintenance fees, especially if the investment balance falls below a certain threshold. Transaction fees. Fees for specific actions such as exchange between funds within the same family or for purchasing additional shares. 12b1 fees. Definition: annual marketing or distribution fees included in the fund's expense ratio, covering promotional expenses and sometimes shareholder services. Impact: these fees can range up to 1% of the fund's net assets annually, affecting overall returns. Trading costs. Definition: costs incurred from the buying and selling of securities within the fund's portfolio, including brokerage commissions and bid-ask spreads. Turnover ratio. A higher turnover ratio indicates more frequent trading, potentially leading to increased trading costs and tax implications. Tax implications. Capital gains distributions. Funds that frequently realize capital gains distribute these to shareholders who may owe taxes on them, even if they reinvest the distributions. Tax efficiency. Some funds employ strategies to minimize taxable distributions, which can be beneficial for investors in higher tax brackets. Classes of mutual funds. Mutual funds often offer multiple share classes, each designed to cater to different investors' needs and preferences. These classes typically represent ownership in the same investment portfolio but differ in fee structures, sales charges, and minimum investment requirements. Understanding these distinctions is crucial for making informed investment decisions. Common mutual fund shares classes. Class A shares, front-end load, incur an upfront sales charge deducted from the initial investment. This means a portion of your investment goes toward fees before being invested in the fund. Lower expense ratios generally have lower annual expense ratios compared to other share classes, which can be beneficial over the long term. Breakpoint discounts offer discounts on the front-end load for larger investments, reducing the sales charge as the investment amount increases. Suitability often suitable for long-term investors who can benefit from lower ongoing expenses over time. Class B shares, back-end load, contingent deferred sales charge (CDSC) do not have an upfront sales charge but may impose a fee if shares are sold within a certain period, typically declining over time and eventually disappearing. Higher expenses ratios tend to have higher annual expenses compared to Class A shares, which can erode returns over time. Conversion feature often convert to Class A shares after a set period, that is 6 to 8 years, at which point the lower expense ratio of Class A shares applies. Suitability may appeal to investors who prefer not to pay an upfront sales charge and plan to hold the investment long enough to benefit from the eventual conversion to Class A shares. Class C shares, level load, typically do not have an upfront sales charge but may charge a small fee if shares are sold within a short period, that is 1 year. Higher expense ratios maintain higher annual expenses indefinitely, which can significantly impact long-term returns. No conversion. Do not convert to Class A shares, so the higher expense ratio remains as long as the investment is held. Suitability. Often considered by investors with a shorter investment horizon due to the absence of significant sales charges upon purchase or redemption. Class 1 shares, institutional shares, lower expense ratios, feature lower annual expenses due to reduced marketing and distribution costs. High minimum investments require substantial minimum investments, often in the range of $5 lakh or more, making them accessible primarily to institutional investors or high net worth individuals. Suitability designed for institutional investors or individuals with significant capital to invest. Class R shares, retirement plans, significantly offered through employer sponsored retirement plans like 401ks. No sales charges, generally do not impose front-end or back-end sales loads. Variable expense ratios. Expense ratios can vary. It's essential to review the fund's prospectus for specific fee information. Suitability intended for participants in retirement plans, providing a convenient investment option within employer-sponsored programs. Key considerations when choosing a share class. Investment horizon. Long-term investors might prefer Class A shares to benefit from lower ongoing expenses. Despite the upfront sales charge, shorter-term investors may find Class C shares more appropriate due to the lack of significant sales charges. Investment amount. Larger investments in Class A shares may qualify for breakpoint discounts, reducing the front-end load. Institutional shares Class 1 require substantial minimum investment but offer lower expense ratios. Fee structure. Understanding the different fees associated with each share class, including sales loads and expense ratios, is crucial. Higher ongoing expenses can significantly impact net returns over time. Availability. Not all share classes are available to all investors. For example, Class R shares are typically accessible only through employer-sponsored retirement plans. How mutual fund shares are priced. Mutual fund shares are priced based on their net asset value (NAV), which represents the per share value of the fund's assets minus its liabilities. The NAV is calculated at the end of each trading day after the market close, typically at 4 p.m. Eastern Time. Calculation of NAV. Valuation of assets. The fund's accounting agent assesses the current market value of all securities and assets held within the fund. This includes stocks, bonds, and any other investments. Deduction of liabilities. From the total assets value, the fund's liabilities such as management fees, operating expenses, and any other obligations are subtracted. Division by outstanding shares. The resulting net value is divided by the total number of outstanding shares held by investors, yielding the NAV per share. Key points. Daily pricing. NAV is determined on daily after market close, meaning all buy or sell orders placed during the trading day are executed at the NAV calculated at the end of the day. Forward pricing. Mutual funds operate on a forward pricing basis. This means that transactions are executed at the next calculated NAV, not at the NAV of the time the order is placed. For example, if an investor places an order at 2 p.m., it will be processed at the NAV determined after the market closes that same day. Impact of transactions. Large purchases or redemptions can affect the fund's NAV. To manage this, some funds may implement measures like dilution levies to offset the costs associated with significant transactions, ensuring fair treatment of all shareholders. Expense ratios. Ongoing fees such as management fees and operating expenses are accounted for in the fund's liabilities and thus impact the NAV. Higher expenses reduce the NAV, affecting overall investors' returns. Loss of mutual funds. Diversification. By pooling investments from multiple investors, mutual funds provide access to a diversified portfolio, which can help mitigate risks by spreading investments across various asset classes, sectors, and geographical regions. Professional management. Fund managers bring expertise and experience, making informed decisions about security selection and portfolio management. This is beneficial for individuals who lack the time or knowledge to manage their investments. Liquidity. Investors can typically redeem their shares at the fund's net asset value at the end of each trading day, offering easy access to their money compared to other investment types like real estate or fixed term securities. Convenience and accessibility. Mutual funds are easy to purchase and manage through brokers, financial institutions, or even directly online. They are suitable for investors with varying levels of financial acumen. Economies of scale. Pooled resources allow mutual funds to access opportunities that might be cost prohibitive for individual investors, such as certain high-value securities or international markets. Cons of mutual funds. Fees and expenses. Mutual funds charge fees like expense ratios, sales loads, and account fees. These costs can reduce your overall returns, particularly in actively managed funds with higher expense ratios. Lack of control. Investors do not have a say in the fund manager's decision-making process, including which securities to buy or sell. This may not align with individual preferences or goals. Over diversification. While diversification is typically beneficial, Excessive diversification can dilute potential returns as the performance of strong assets may be offset by weaker ones. Market risks. Mutual funds are subject to market fluctuations and there is no guarantee of returns. The value of investments may decline during downturns. Tax implications. Mutual fund investors may face capital gains taxes even if they do not sell their shares, as the fund's internal transactions can trigger taxable events. Evaluating mutual funds. Evaluating mutual funds requires a comprehensive analysis of various factors to ensure they align with your investment objectives and risk tolerances. Here's an expanded guide to assist you in this process. Performance history. Absolute returns. Examine the fund's returns over multiple periods 1 year, 3 year, 5 year, and 10 year to assess consistency and growth potential. Relative performance. Compare the fund's returns against relevant benchmarks or indices to determine its effectiveness in meeting or exceeding market performances. Risk-adjusted returns utilize matrices like the Sharpe ratio, which measures return per unit of risk to evaluate whether the fund's returns justify the risk taken. Expense ratios and fees. Expense ratio. This annual fee, expressed as the percentage of assets under management, covers operational costs. Lower expense ratios can enhance net returns over time. Sales loads. Be aware of front-end charged at purchase and back-end charged at sale loads, as these can impact your initial and final investment amounts. Other fees. Consider additional costs such as redemption fees, account maintenance fees, and 12B1 fees, marketing and distribution expenses. Fund manager's expertise, tenure and track record. Assess the experience and historical performance of the fund manager. A manager with a proven track record may indicate potential for future success. Management style. Understand whether the manager employs an active or passive investment strategy and how it aligns with your investment philosophy. Investment objectives and strategy. Alignment with goals. Ensure the fund's stated objectives, example growth, income, capital preservation, match your personal financial goals. Investment approach. Review the fund's strategy, including asset allocation, sector focus, and investment criteria to determine compatibility with your expectations. Risk profile. Volatility measures. Analyze metrics such as standard deviation and beta to gauge the fund's volatility and sensitivity to market movements. Credit quality. For bond funds, examine the credit ratings of the underlying securities to assess default risk. Concentration risk. Evaluate the diversification within the fund to identify potential overexposure to specific sectors or securities. Portfolio composition. Asset allocation. Review the distribution of investments across asset classes, equities, bonds, cash to ensure it aligns with your risk tolerance. Sector and geographic exposure. Understand the fund's exposure to various industries and regions, considering economic and potential political factors that may influence performance. Turnover ratio. A high turnover ratio can indicate frequent trading, potentially leading to higher transaction costs and tax implications. Distribution and dividends. Yield analysis. Examine the fund's dividend yield to understand the income generated relative to its share price. Distribution history. Review the consistency and growth of dividend payments over time. Reinvestment options. Determine if the fund offers automatic reinvestment of dividends, which can enhance compounding returns. Tax efficiency. Capital gains distributions. Frequent distributions can lead to tax liabilities. Funds with tax efficient strategies aim to minimize these events. Tax managed funds. Consider funds specifically designed to reduce tax implications through strategic investment choices. Fund size and scalability. Assets under management. While a larger AUM can indicate popularity, it may also lead to challenges in managing the fund effectively, especially in niche markets. Liquidity. Ensure the fund has sufficient liquidity to meet redemption requests without impacting its performance. Fund family and reputation. Sponsors track record. Research the reputation and history of the fund's sponsoring company, including regulatory compliance and customer service quality. a range of offerings. A diverse selection of funds from the same family can provide flexibility if you choose to adjust your investment strategy. Example: for instance, an investor seeking growth might choose an equity for mutual fund focusing on technology stocks, while someone seeking income might opt for a bond fund investing in corporate debt. Mutual fund versus index funds. Index funds are a type of mutual fund designed to replicate the performance of a specific market index, such as the S&P 500. They are typically passively managed, resulting in lower fees compared to actively managed mutual funds, which aim to outperform the market through active investment decisions. Mutual funds versus ETFs. While both mutual funds and exchange traded funds offer diversification, they differ in trading mechanisms and fee structures. ETFs trade like stocks on exchange throughout the trading day, with prices fluctuating, whereas mutual fund shares are bought or sold at the end of the day NAV. ETFs often have lower expense ratios and may offer more tax efficiency. The bottom line: mutual funds provide diversification, professional management, and liquidity, making them a popular choice for investors with varying financial goals and risk tolerances. However, it's important to carefully consider associated fees, market risks, and tax implications to ensure the investment aligns with long term financial objectives. Thank you very much.